Hey,
Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Jimmie, how you doing today?
man, I am rolling, rolling,
There
rolling.
we go. Rawhide.
Yes,
Rawhide,
I'm doing
baby.
great. How are you?
I'm doing good, man. I'm good. It's Friday.
It's
Looking
Friday. It's
forward
going
to
to be
the
warm today too. It's a
it's gonna
nice
be a
day.
nice day. Looking forward to the weekend. And
Yeah,
we got a lot to talk about though, dude.
man. I'll tell you what. It is. Since the conference, it seems like we just had like this slew of things going on. I don't.
Yeah.
Maybe we were the incentive to get some things
I
out there.
think
I don't
so.
know.
I think we
Maybe.
were a catalyst for sure. And so today we have a bunch of stories that actually directly relate to some of the things we talked about
Yeah.
at the conference. But I want to start with big news that came out yesterday afternoon, I believe,
Yeah.
from the Securities and Exchange Commission's Division of Trading and Markets. They issued a new FAQ clarifying how broker dealers should treat payment stablecoins under the broker dealer net capital rule.
Yeah.
And so the big deal about this, Jimmie, is that stablecoins will now have a 2% haircut rather than a 100% haircut, which was how most broker dealers were treating it. I don't think the SEC had clarified up until yesterday
Right.
how stablecoins should be treated under the net capital rule. But going from 100% to 2% is obviously a huge deal and would lead presumably to more broker dealers inventorying stablecoins, right?
Absolutely. I mean, this is incentive to inventory stablecoins, and the kind of the cool thing about this. I mean, because let's face it, almost all brokerage firms are either owned by banks or part of banks,
Hmm.
and we can assume that hey, this could bleed over into the banking side. But now, what this means for brokerage firms is that stablecoins are going to be treated just like other really liquid assets, like money market funds.
Yeah.
And so, for capital purposes, which I know most people are like, that's the most boring thing in the world, accounting and capital and stuff like that.
Yeah. Break it
It's
down. Why
really,
does it matter?
yeah, but it's really not, because now these can be used as capital for the firm.
Yeah.
And so, just like any other financial institution, brokerage firms have to hold so much capital. And so, this is now going to be part of that capital because it's only going to have a 2% haircut on it. So, I mean, this really changes the incentive for them to take stablecoins. Before, it was almost like a liability. I'll do it, but I don't really want to, and there's no
Yeah.
preferential treatment. There's no reason really to do it except that my customers want me to.
For sure.
Now there is a reason to do it. This can be, and we have to say, okay, if that's the case for brokerage firms, how long is it before banks do something very similar and start calling this, liquid? These are highly liquid,
Yeah.
capital assets.
Yeah. No, it's a good point. I mean, so just to kind of break it down for folks who sort of aren't familiar with capital regulation, obviously the banks are subject to, capital regimes under the Basel framework. Broker dealers, it's a bit different, right? That's the net capital rules
It's a
administered by
little
the
bit different.
SEC. It's less, because there's not sort of maturity and liquidity transformation occurring within a broker dealer. It's maybe not as onerous, I guess. But you just start with the simple premise that, right, assets minus liabilities is essentially capital, right, as owner's
Right.
equity. So, what we're saying now is, okay, well, previously, if a broker dealer had stable coins, right, that was 100%, meaning that they deducted the entire value of the stable coin from the asset side, which obviously then lowers the equity, right, lowers the
Right.
capital, right? Now, a 2% haircut, you're significantly increasing, of course, right, the ending equity that you have. So
Yes.
that's what makes it such a big deal here. And it's just further evidence, Jimmie, of what we talked about at the conference, what we've been talking about on the show forever, which is integration of stable coins into traditional finance, right? And
Yeah.
this is going to be this is going to be an enabling factor,
This is
right?
a hugely enabling factor. And as I said, I think this is going to provide incentive that just didn't exist before, right? I
Yeah.
mean, honestly, it was kind of a negative, but brokerage firms would do it just satisfy customers. They do. I mean, it was kind of like a loss leader if you were
Hmm.
in retail or something like that. But now, totally different situation. Now, can states come in and change that? Yeah, but the pressure will be huge.
Yeah.
It will be very, very difficult to undermine that at the state level. So I mean, I think that, I would think we're going to see a big push to start bringing stablecoins in as assets at brokerage firms now. I mean,
Yep.
this could be a very substantial element of brokerage firms. I would think moving forward, the thing that people don't get in a lot of cases, in particular for the big wirehouses, and we talk big wirehouses, we're talking, Merrill Lynch, we're talking Wells Fargo Advisors, we're talking, places like that do a lot of retail business. Their assets haven't really gone up in the past years. Now, if you looked at it, you would say, oh yeah, their assets have gone up, but they've gone up with the increasing markets. Rising tide lifts all boats, kind of thing. Organically, they really haven't. They're not attracting more customers. Their customers are older, and they continue to be older, kind of like their financial advisors. And they're in a very precarious place of trying to grow in an environment. In particular, if it was a flat market environment, they would have a really, really difficult time. And so this could be that linchpin they've been looking for to do two things: one, to grow organically, but also to bring in the millennials that they all are dying to bring in. Those have gone to places like Robinhood and some of the online firms. But the big wirehouses have been pretty much wondering how are we going to bring this next generation in.
Great point.
I think
especially as the great wealth transfer, great wealth transfer, continues apace here, and the baby boomers die off and pass their assets on to their heirs. You gotta kind of meet customers where you're at and where they're at, and
I think so.
Young folks are increasingly into digital assets and other things. So great point there, Jimmie, and we're going to see obviously how broker dealers respond to this change. That'll be interesting to follow. Okay, so let's move on to continue with sort of stable coins and integration into TradFi. You and I talked several months ago about Fed Governor Waller's proposed skinny master account idea, right? And the Fed then subsequently sort of put that in a formal proposal, right, that they then sought public comment on, and that comment period closed earlier this month.
Right.
And so, they got a number of comments, obviously from, crypto firms and fintech firms, as well as from banking firms. And I've read some of the comments and the commentary on it. It's kind of one of those sort of situations where no one seems to be particularly happy about the proposal, which
I
don't know, like
nobody seems to be happy on either side of the equation.
Which I kind of as a rough heuristic, I kind of view that as like a good sign. Like probably like the Fed maybe got it right. Like if like no one's happy, then maybe you got it right. I don't know.
Maybe.
Right. So So just to break it down for folks, right? Obviously, a master account is essential if you want access to the Fed's payment system. I mean, you don't have access unless you have a master account.
Well, and
if you want to have dollar
and ACHs, I mean, this
ACH,
is
FedWire,
ACH,
FedWire, interest on reserves. If you want access to U.S. dollar clearing and central bank money, you need a master account. Okay,
right.
And historically, the Fed has not been transparent about who gets master accounts. In fact, we didn't even know, the public did not know who got a master account until a few years ago when former Senator Toomey made a big deal about this and inserted language in a bill that required the Fed to disclose who got a master account. This was in the wake of back and forth litigation with Custodia out there in Wyoming, who had been denied a master account by the Kansas City Fed. When the Fed released who had master accounts, people were like, okay, what? This is all over the place here. So, and so we talked about this with Carl Goss at the panel on banks and crypto at the conference, Jimmie. And so basically, Governor Waller's point was like, look, there's all these new payment startups, right? Fintech firms. They're not traditional banks. They're not depository institutions. Now we have the Genius Act, okay? And, as we talked about it again at the conference, we have a lot of stablecoin issuers applying to be a national trust bank with the OCC. Now national trust banks are eligible for a master account, but the Fed is not required to give them a master account.
They're not required because there are no hard and fast rules, or at least it doesn't seem like there are.
Well, and the Fed, a few years ago did issue guidance at the board level, because part of the issue was that these decisions to grant master accounts were made by the 12 district banks, so there wasn't a lot of centralization. So the Fed Board of Governors recognized.
Opaque.
very opaque,
Yeah,
extremely opaque, which is kind of the Fed's MO historically, and it's gotten them in hot water. I mean, a lot of the
yeah,
criticism the Fed has been receiving of late are warranted, frankly, in my
yeah,
opinion.
yeah. It is well deserved.
Yeah, they haven't they have their sort of penchant for secrecy has not served them well recently. So and that's a whole episode, Jimmy.
That,
Anyway, so we're
that,
getting a field here. So basically, Waller was like, "Look, maybe there's a way to kind of thread the needle here and provide access to a limited suite of Fed payments, features to some of these new payment entrants." And he called it the skinny master account. So
Mhm.
you wouldn't get all the bells and whistles that come with a full master account, but you would still get access to essentially U.S. dollar
Some of the
clearing,
utilities.
some of the utilities, and that means that if you're a stablecoin issuer or another fintech payment firms, that means that you could potentially cut out some of your third party relationships, right? And
Yeah,
obviously that's going to be costly, and so you'd save money, and presumably you'd be able to pass that savings on to your customers. So that's the gist of it, Jimmy. And the banks are saying, look, we kind of think that this is very risky and the Fed should pause. They actually called, so the Bank Policy Institute, the Financial Services Forum, they said that the Fed should wait 12 months before granting these new skinny master accounts, just to make sure that these firms hold up. They don't really
right.
have a lot of operating history here. Some of the fintechs and the crypto firms like Circle, for instance, and Anchorage, they said that the skinny accounts are prohibitively inflexible. For instance, they do not allow Fed ACH, as you
Yeah,
mentioned.
yeah,
They don't allow, there's limits on, how much you can keep in the account at the end of the night, which, is not going to be particularly helpful if you're processing a large volume of payments.
right.
You don't get interest on reserves and
You can't get
whatnot.
interest.
So,
Yeah,
so I don't know, we'll see where things go from here. It depends, I guess, on sort of which constituency the Fed wants to satisfy the most here. I mean, I think part of the issue, Jimmy, is the Fed is in a unique role when it comes to payments because they're a payment system operator, which means that they have counterparty risk, right?
right.
And so a lot of this proposal is about addressing the
It is
counterparty risk
definitely
that
about
they
counterparty
that
risk.
they face, but they're also a regulator too. And so there's always been a tension, with those sort of dual hats that the Fed wears when it comes to
I mean,
payments.
this goes though for a lot of federal agencies. I mean, the FDIC is really an insurance company, folks. It's
Hmm.
not a regulator, but don't tell anybody
They're
in the
both. They're
FDIC
both,
that.
though. They're both.
Well, they are, but they are started out as they're insuring deposits. And they have to do what they need to. It's like an insurance company can tell you, I'm not going to insure your house unless you have XXX, which is fine. But
Yeah.
they're wearing and the Fed, I think, is obviously they've expanded their purview of their regulation purview over the years. Maybe it's natural, I don't know, but you're seeing this. But in this particular case, I mean, banks are against it. The fintech firms aren't happy with this skinny account, the parameters that are in it. So when we think through, why, I mean, I have my own thoughts around this, Lee. I think that most of the
Mm,
banks are seeing this as just another way where deposits are going to leave out the front door.
probably.
I mean,
Yeah.
I think that's probably the biggest concern, don't you?
Well, it's obviously slowed down the market structure, Bill. So, yeah, I mean, I'm sure that's a factor in their opposition to the skinny master account idea. Absolutely.
I mean, if I look at this and I've been thinking about this a lot. I do a lot of work with community banks and credit unions, and I think
Hmm.
that the comparison, and I'm going to get on my soapbox here for a minute, but
Okay.
I
Well,
think
go
we
ahead.
often see a comparison of the U.S. banking system and how fractured it is because
Hmm.
of the size, right? We have 5,000 community banks, 5,000 credit unions in the United States. People hear about the big national banks, but if you live in rural areas, you get these smaller places. And if you go to
Yeah.
other countries, they say, "But why does it have to be that? Why do in Germany we don't need this, in England we don't need this. We only have a dozen banks, and it works fine."
Yeah.
The United States is a very, very different place. I think we're a very independent peoples here in the U.S. We're a big country with that is not near as densely populated as a lot of those other places too.
Yeah.
And the size, the magnitude of the actual landmass that is the United States is part of the defining characteristic. but we're fiercely independent people too. And I think those kinds of institutions support that, that life that we've grown up with.
Mm-hmm.
That that the when I say grown up with, the country has grown up as, and we continue to be fiercely independent. And so I can see where they're coming from, but but you can't stop change either, right? So you need to learn. You can't stop the waves, so you need to learn to surf. That was Zen. Yeah.
Wow. Look
But
at that.
I think, instead of fighting this, what they, would probably be more beneficial is to embrace what these fintechs are offering, right? Embrace some of the
Yeah.
services and things like that they're offering. And folks, you're not going to see it out of the big banks. Big banks aren't the first movers in these things. It's almost always community banks and credit unions that are first movers. We mentioned it before on this. If you look at who went online first and who gave you online access first and who gave you your statements electronically first, and those were all community banks and credit unions. Those weren't Bank of America and Wells and those kinds of places. And so I do think that maybe they've gotten out of that mode a little bit. Although we had a credit union about a month ago that floated their own stablecoin.
Yeah.
Um,
Yeah. Yeah. Yeah.
and
Instant
so
cloud.
so some of them are still in that mode, but I think that
Mm-hmm.
you're not going to stop this. This is going to happen. Whether it's called skinny account or something else, rather than trying to put up bigger walls around your deposits, leapfrog the fintechs, move into that space in a more aggressive way, and people won't have a reason to leave.
Yeah. I mean, I don't really disagree with you, actually. You saw this debate flare up in the wake of SVB's failure,
Yep.
because a big part of the logic behind effectively bailing out SVB's depositors, right, uninsured depositors, was that if the government didn't do that, that would lead to a run on essentially every regional bank and perhaps community banks, right? That this could sort of be the death of community banking as we know it, because we all know that the government's never going to let a JP Morgan or a Bank of America fail, right?
Right.
Um, I think that was
Or an
probably,
SVB.
well, I mean, yeah, I mean, essentially, you're just saying, okay, like, yeah, SVB is the cutoff there. So I thought, at the time, I kind of thought those claims were exaggerated. Not to deny that there would have been pain, right?
Right.
Because this is the way that the market works. Is in a time of panic or stress, right? There's always kind of the entity that's in focus in terms of sort of, are they on the precipice of failure? And then if they do go under, right, the market's attention turns to entities that look like the one that just
Yeah.
failed, right? So this was, classic fall of 2008, right? It was, okay, Bear goes under, shotgun wedding with JP Morgan. Okay, who's next? Oh, Lehman, right? They're
Yeah.
kind of the next weakest. Oh, Lehman goes under, who's next? Right? Merrill, okay, Merrill, boom, Bank of America, who's next? Morgan,
Yeah.
right? Morgan gets the investment from the Japanese, Morgan Stanley, and then who's next? Oh, boom, Goldman, and then the
Goldman.
government's like,
Yeah.
right. So that's generally how it works. It's a domino, and it's the kind of the weakest antelope on the prairie or the savannah type of situation. But I agree with you, Jimmie, that community banks and the diversity of banks in this country is a strength of ours that should be preserved
Yeah.
at all costs, because the reality is that for large banks, it's just not worth their time and effort to serve clients beyond, below a certain threshold, right?
Yeah.
Like JP Morgan, it costs them the same to underwrite $1 million loan as a $100 million loan, basically. Right. So they're
Probably.
obviously
Yep.
they're obviously going to go with the $100 million loan. Right.
Yep.
And there's a lot of evidence to suggest that community banks serve a disproportionate amount of small businesses, right? And
Sure.
small business and starting businesses is an engine of innovation in this country for sure. So
Lifeblood of America.
lifeblood of America, and I've been my first bank was a community bank. I've used credit unions as well. I mean, the two times I've gotten auto loans have been through the Farm Credit Federal Employees Credit Union, right?
There you
Both
go.
my parents worked in the Farm Credit system, and and it was very informal and flexible, right? You just call the dude, say, hey, I'm buying a car, can I get a loan? And then they wire you the money, like, and then you do the pay, right? It's that's kind of how it works.
It is kind of how it works with those
and,
places, which is
and
nice.
it is not, yeah, because it's the personal touch, right? So I'm totally with you here, but it comes back, Jimmy, and you know this because you and I talked about this a lot. I don't frankly hear anyone else talking about it the way that we're talking about it, is the core providers, right?
Yeah.
It's the
The
core providers
core
because these
providers,
community banks, because
yeah,
a lot of them are too small. They don't run their own tech stacks,
right.
right? They just don't have the resources and the technological capacity to do that. So they rely on a couple of three, frankly, core
The
providers
core providers,
that
that's
run
it.
the central software platform that are essential for the bank's operations, that handle customer and account management, deposits and withdrawals, loan origination and servicing. And I'm struck when I still, I still have an account at Vermilion State Bank, okay, in Minnesota. When I log in, it is like, I mean, it's like the internet from like the late 90s, when I
Yeah.
go into this thing, right? I mean, it
Looks
is
like a
bad.
Bloomberg machine.
Kind of. Yeah, pretty much.
Monochrome monitor.
It is bad. And so I think, the issue is these core providers, and I know some of them, and I've read some stories about some of them, trying to integrate these digital asset services, right?
Yep.
Doing things around stable coins. But, ultimately it's going to be on them to allow their clients, the community banks, to tap into, right, this new technology, these new products and services. And I think this is honestly something that regulators should be looking into. I mean, this is right? Safety and soundness, which is the core of bank regulation, is all about making sure the bank is profitable enough to be a going entity,
Yeah.
right?
Yeah. That
That's why we
absolutely.
regulate banks, right?
I
Is
mean,
to
the one thing that I do think that needs to happen is that the kind of the regulatory environment needs to be a little more aware of changes and things like that. So right now, they went from FDIC went from 100,000 to 250,000 in
yeah,
insurance. Shouldn't it be like 500,000 or a million? I mean, I think it
yeah,
should for, and maybe you put some provisos around that, but I think that was that when they went from 100 to 250, that was way overdue, right? You have
yeah,
all these older
yeah,
people. I mean, my parents, I was so everybody's heard, if they've listened to this, they've heard me talk about my mother and stepfather, and he passed away last year, and but I've been helping them out with their finances. When he
yeah,
passed away, actually before that, I guess when I was helping them out with their finances, I started looking, and they have money like in cash and CDs, right? They were very risk averse, so they bought CDs, and they had them in all these, in credit unions. I'm not going to say the names of them, but credit unions and community banks all around Clarendon County, South Carolina. And why did they do that? Well, because they're older people, they're retired, they've accumulated this wealth over their time, but they were afraid, right?
yeah,
Because if something happened to this bank, I'm not going to get bailed out. I'm not like I'm not Silicon Valley Bank.
yeah, yeah.
My little bank might not get that treatment, and so they had all the. I mean, doing things like that to support community banks and credit unions. And I'm lumping them together there, even though they're different types of entities.
Yeah, the community banks are getting very angry at you for
Yeah, well,
lumping them
I
together.
know
Yeah,
they are, but but I think those, but putting, having some support from the regulatory sphere, and I don't think it's they're saying, oh, we're not going to do it. I think it's just not even a consideration in a lot of cases.
yeah, yeah. No, that's fair. Well, let's stick with credit unions, Jimmy, because this is a story we wanted to talk
Yep,
about last week. We didn't get the time
we
to do
didn't.
it, which is the National Credit Union Administration, the regulator of federally chartered credit
NCUA.
unions, NCUA. Former chair, good friend Rodney Hood, right?
Yep.
So they issued a rule for permitted payment stablecoin issuer applications. So Jimmy, why don't you tell us about the significance of this?
Well, I mean, I think there are a couple things. One, this came under the Genius Act, and so the chairman Kyle Hoffman, I actually met him at Money 2020, and he
Hmm.
had a million questions about it. I love the fact that credit unions are like that. I mean, it's like Rodney's like that, right? If he has a question, he just asks you.
Yeah,
He doesn't go through a lot of people. It's not like they're very. I think it goes to who they are. But
yeah,
this is a kind of a sea change, and it's basically providing a framework of how the credit union members, federally chartered credit union members, because they're state and federal charter, but these are federal chartered, will be allowed to start facilitating certain kinds
Yeah.
of payment stable coins within their environments. Now, there's still some rules around custodying and things like that that are very different than on the banking side of the equation. Okay, and
Yeah.
so
Yeah.
that's going to be different. But the fact that they are going to facilitate this idea of being able to do more in the stablecoin space, start using these, facilitating payments and things along those lines, is to me a sea change
Yeah.
from where it was before. And part of this is, as I said, it was in in the Genius Act, and they're moving to facilitate those kinds of things at the behest of these credit unions. Because I mean, we saw it at the conference not that long ago. We had a lot of credit unions that were there, and if you ask why they're there, we're here to learn.
Yeah.
And
Yeah.
so I think
Absolutely.
it's going to be a great step for the
Yeah.
for the NCUA members. And I applaud the chairman and his staff for moving on this pretty quickly in the big scheme of things. I mean, this is 5,000 institutions, folks. This isn't like a small, handful. Moving on this as quickly as they did. What's your thought on it?
Well, just to add a little detail, I mean, so this is obviously something that was required of them under the Genius Act,
Right,
and so we're going to be seeing more stories like this because I think the law goes into effect in July, I believe. So
yep,
essentially, when the law passed, it gave various agencies a year to develop the required rulemakings. Okay. So this is in keeping with that effort. Now, just to clarify an important point, Jimmy, because under Genius Act, uh, insured depository institutions, which credit unions fall under
right,
that umbrella, are not allowed to directly issue stablecoins. However, a
right,
subsidiary of what's called an IDI, insured depository institution, can issue stablecoins. And so part of this rulemaking was clarifying what constitutes a subsidiary of a federally insured credit union. And then what does that application process look like? Now, the NCUA said, um, look, if there's a parent company, right? So if the stablecoin issuing subsidiary has a parent company that is a federal credit union, then the parent company needs to apply jointly with the subsidiary to the NCUA to be a
right,
permitted stablecoin issuer. Okay. Um, and then so it kind of provided some clarification around what it means to be a parent company,
right,
right? The requirements. So it says if the parent company, so a federally insured credit union is a parent company if they vote 10% or more of any class of voting securities of the stablecoin subsidiary, or if it can direct the management or policies of a PSI, right? So it's just providing, I think, a little helpful clarification for credit unions that are
It
thinking
does.
about doing this.
Again, the one aspect I think that's going to be a little more challenging is around the custodying. That's going to
Mm,
be that's because they can't custody directly, and so that's going to be, I think, a little bit more of a challenge. I don't think it's like something they can't do,
yeah.
but I think that's going to be a little bit more challenging on that side. In particular, if you want to do something like hold stablecoins as collateral for loans,
Yeah.
which I think is, I mean, honestly, I've probably heard more people ask about using stablecoins as collateral or another cryptocurrency as collateral than anything else. I've had a lot of lay people ask me why. Why do they care? Why don't they just sell
Lay
their
people.
their cryptocurrency? It's like taxes. That's why.
Yeah.
People don't want to pay taxes, and they would rather borrow against it, which is the same reason people take out margin loans often to buy things other than stocks, is because they don't want to pay the taxes.
Hmm.
And so this is a way to keep earning, if you have staked coins or anything like that, earning yield
For
and
sure.
avoiding any kind of capital gains taxes.
No
And
doubt.
so
No doubt.
there are
Yeah.
there are a lot of other elements that are that go into this. I mean, I think like I said, I applaud NCUA for moving ahead and and doing it reasonably quickly in the big scheme of things.
Yeah. Yeah.
I mean, hell, you and I
How
talked.
many how many podcasts are covering credit unions? I don't know. I mean, we're kind of
Probably not too many.
we're
I
giving
think
you
we're
the
probably on
inside
our
skinny
own.
here, folks. Okay. All right, Jimmy. Well, I want to end with a story that dominated the kind of financial news this week, and not directly digital asset related, but it's digital asset adjacent, right? Which is prediction markets. And it is, this thing is growing. I mean, frankly, the situation is a complete mess. I mean, you and
Yeah,
I have talked about prediction markets before. I think we are of like mind
we
on
are.
these things. We keep referencing Biff's World,
And when did they
but
even come up with prediction markets? Where did who came up with that name? There isn't. You're predicting absolutely nothing. This is a betting parlor. That's all it is. That's
yeah,
all it is.
it's event contracts. And yeah, I'm with you.
Call it what
And
it is.
so, yeah, fair. So anyway, but why is it? Why is it related? Well, because the largest crypto firms
Yeah.
want to get in on the action, are getting in on the action,
I don't,
right?
there's a
Um,
million, people doing this every hour. I mean, yeah, of course you want to get in on it.
yeah,
You have to draw the line somewhere, though. I mean, for God's sakes, I mean,
yeah.
I don't know. I feel like if I were, I mean, this is probably why I'm not running one of those companies. You have to stand up and say, "Hey, folks, come on," or you're honest about it and say, "Yeah, we're going to let you spin the roulette wheel if you want." But be honest about it.
Well,
Don't call them what they're not. They're not. There's nothing prediction like about it. There's nothing scientific about it. These are just betting. That's all they are.
I agree with you, but I would my long sort of held stance is that buying crypto is also spinning the roulette wheel. So anyway,
Well, I mean,
but
buying
okay,
any
so here,
stock if you want to say it that way, but
well, I mean, at
I don't
least
think so.
there's an actual legal entity and there's earnings. Anyway, we don't need to go down that path.
We've been down that path
So,
before.
yeah, so I mean, that's kind of the premise of our whole relationship and show and whatnot. So,
It kind of is.
anyway, so okay, what happened this week? In case you've been living under a rock, is Mike Seelig, the relatively new chair of the Commodity Futures Trading Commission, has sort of weighed
Yep.
in prediction markets in a big way. And so, for background, again, for folks who aren't familiar, prediction markets have been operating under, the sort of regulatory cloud, uncertainty, whatever you want to call it, for a while. And the question is, are these contracts that they're offering, which, are called sort of event contracts, are they considered swaps under the Commodity Exchange Act, in which case they would fall under the exclusive jurisdiction of the Commodity Futures Trading Commission? Or, as you are suggesting, Jimmie, is this effectively just gambling, in which case it would fall under
All to the states. Yeah.
state gambling law? So that's the, I'm leaving some nuance aside, right? But that's kind of the crux of the issue, is
Yep.
that who is going to be responsible for regulating these markets? Is it going to be the states, or is it going to be the Commodity Futures Trading Commission? Okay.
You know who I think would absolutely. I don't think I don't know if he'll answer me. Billy Walters, who wrote that book, The
Oh yeah,
Gambler.
yeah,
Remember that
yeah,
book?
yeah,
Awesome book, awesome story. I wonder what he would think of what he thinks of these. I mean, it's not like he's not still around.
yeah.
I would love to know what he still thinks, because he had such a large gambling company. I mean, this is what they did. They gambled on all kinds of sporting events
Hmm.
and things like that, and they did very, very well.
I
I
think he would
wonder.
pick the CFTC. I think he'd want the CFTC to be,
You think so?
to regulate. So,
I'm
and
gonna try to reach out to him.
and the advantage. So, look, so obviously, Kalshi and Polymarket are the two big ones.
Yeah.
Okay. But now crypto.com, okay, is trying to offer event contracts on their platform. Coinbase, right,
Yeah.
is trying to, and we talked about this with Ryan Van Grack on the litigation panel, because they preemptively sued several states,
Yep.
over this issue. And, and so that means then that these platforms would be able to operate under one rule book, right? The CFTC's rule book,
Yep.
which is a principles-based regime, as opposed to 50 different, state laws.
State regimes. Yeah, sure.
And, and there's a couple, and beyond that, I mean, there's a couple big, kind of specific requirements that are applicable when you're dealing with the CFTC. One is the age. So 18.
Yep.
18 and up can trade on CFTC regulated platforms. 21, most states, it's 21 and up, right, to trade on gambling platforms, on sports books. They're not required to have sort of a problem gambler kind of, helpline and
Right.
and flag that, right? So there's no sort of a aspect to sort of control,
Do people really
controlling.
use those? I don't know. I mean,
I
do you
don't
think
know. I mean,
people really use
if you
those?
watch the ads, they always have the
I
numbers at the
know they always
bottom
have ads on
of the
there.
screen, and a few other things, right? That obviously these platforms would prefer not to deal with here.
Right.
So okay, so C League. So Selig issues a Wall Street, he writes a Wall Street Journal op-ed earlier this week, and he times it with this very kind of awkward video that he posted to X, and he ended by "We'll see you in court" to the states, threatening the states, which is like, I don't know, it's very weird for like a
It's
regulator to like challenge all the states.
yeah.
Like I don't, why would you do that? And actually,
He's a lawyer. That's why. I mean,
Utah governor,
this
well, like
is
no,
where
to
he
like
made his
open,
bones,
well,
though.
to
I
like
mean,
well, to
you know,
openly, no, I mean, like that, yeah. I mean, obviously, if you file a brief, that's something else. But like to just openly, sort of say to the states, literally, we will see you in court in this
yeah,
kind of, social media video is, pretty provocative.
it is.
And
It
and
is.
you saw Utah Governor Spencer Cox respond immediately saying, look, this, it basically said what you said is like, sorry, Mike, this is gambling. We all know it, right? You know it, I know it. Vegetable lasagna knows it,
Yeah.
and we disagree, and we're going to fight this out in court. So that's the gist of the situation, Jimmie. And so, along with that announcement, CLEC actually filed, the CFTC filed a friend of the court, an amicus brief in the Ninth U.S. Circuit Court of Appeals involving Crypto.com's case against the state of Nevada, right? The state of
Yeah.
Nevada is claiming that they are operating illegally, serving Nevada customers illegally because they're not registered with the
Because
Nevada
they're not
Gaming
registered.
Commission.
Yeah.
So, so this is going to be a story. I mean, ultimately, it's going to work its way up to the Supreme Court. I don't see any other outcome in which the Supreme Court is going to have to weigh in on this. And I'm not ready to predict, how they'll weigh in one way or the other. But this is going to continue to dominate the news
I
here
think it is.
because these
It
things
is
are
going to.
because people are using because they're using
People
it.
use this stuff. I mean,
They use
absolutely.
it.
I saw Kalshi advertising on the Olympics. I mean,
Yeah.
this is
Super Bowl too.
huge.
Yeah. Yeah.
Super Bowl. I mean, you're seeing it out there. You have a lot of people that are doing this. I mean, people wouldn't be getting in this if they weren't making money, right? And so there are a lot of people that are moving in this direction. I have to think states are going to be worried that they're going to lose gambling revenues and
Yes, of course
revenues
they
in
are.
their state
Yes.
lotteries and things like that.
Yes.
People are going
Yes.
to be, they're going to move their money to these. And so I would think states would not only want to control these, but they're going to want their pound of flesh. They're going to want to tax these
Yeah.
things.
Yeah.
So I can, I will predict that within a year, I think this hits the Supreme Court fast. I think within a year, you're going to see states asserting their ability to tax these because they're going to see this as a way to regain revenue that they're losing now.
Yeah.
I mean,
Yeah.
that's really, at the end of the day, folks, states don't really, I think that's the only reason they really care is the ability to tax these things because they are going to lose revenues to these. They're probably already, not going to, they're probably already experiencing a loss
Yeah.
of revenues. And so I think that's a big part of it. Is there some protection of their constituents and things like that? Maybe a little bit of that, but
No,
a
there
lot
that
of it is
is the
revenue oriented.
I agree. Mostly revenue, for sure. But, states historically have been on the front lines of consumer protections because they're the first to hear about it,
Right.
right? They're the first to hear the issue. I mean, this was the same thing with the subprime issue, the subprime credit, right? Because like,
Yeah.
you had people like, real people, right, getting, put into these crummy mortgage products, that they couldn't pay off, when it reset or whatever.
Right.
And, they were first going to their, their local representative, then state. So the states were on the front lines. The states are on the front lines now. We're going to look back and it's already starting to happen, Jimmie, but I think in 5 years' time, we're going to look back the way we sort of view social media now, which is like, how did we let this happen? How did
Yeah.
we let our young people, how did we sort of abandon our young people and let them become addicted? Because this is what's happening. There are millions of young people who are becoming addicted to sports gambling.
Yep.
Gambling addiction, it's the addiction that leads to the most suicide because it operates, no one knows, right? Until it's too late. No one knows. There's no sort of outwardly visible
Yep.
signs that people are dealing with this. And it's disgusting. I loathe it. I think the CFTC is wrong on the legal merits. But I also think there are tremendous conflicts of interest here because Donald Trump Jr. serves as an advisor to both Kalshi and
Let's don't even go there. That's obviously a massive conflict of interest.
And Polymarket, the president's Truth Social, I think, platform is also trying to integrate prediction markets. So, and by the way, we didn't talk about this story. We'll maybe talk about it next week. Guess who was down at Mar-a-Lago this week for the World Liberty Financial Summit, which was Mike Seelig, right? So,
was he really?
Yeah, he was there. He spoke.
Oh, that's right. He did speak. I did see that. Yeah, that's right. He did speak.
He spoke on stage. So, I mean, this is a grift of all grifts. It is absolutely disgusting. And to top it off, Jimmie, now that, we even have more grifters getting in on the grift because several asset managers have filed to list ETFs tied to specific contracts that trade on prediction.
Absolutely have.
I mean, which is just unfreaking believable.
Yeah, I think we have to end there. I mean, this is just, folks. You know where we
stop grifting, people. Stop grifting.
Stop grifting.
Okay? All right, Jimmie.
Americans deserve better.
That's right. All right, brother. A lot of fun as always. Have a great weekend, and I'll see you next week.
You do the same. Have fun out there.